We can't raise the minimum wage. Why? Because small businesses wouldn't be able to afford it. Why? Because if they had to pay people more, they wouldn't be able to have as many people, or they'd have to raise prices on products in the store. So that means more people wouldn't go to the stores anyway. Why? Because people would rather go to Walmart or someplace that has a lot more stuff for cheaper. People like cheaper stuff. Why? Because not a lot of Americans have a great amount of disposable income. Why? Because minimum wage is only $7 an hour.
There's one thing Republicans are good at, it's misunderstanding things. And this TikTok does an excellent job of demonstrating that. Just by asking some very basic questions, we can get to the bottom of things really quick. And Republicans tend to not ask those questions. Instead of looking at things at a systemic level and realizing that, wait a minute, we have a consumer-based economy, maybe workers are also consumers. And perhaps wages need to be high in order for our economy to work. Because higher wages means more spending. But of course these Republicans would much rather we spend money without making it, because that would mean paying workers. But the reality is, a lot of Republicans who go out of their way to say that the minimum wage should be lower are really just making a value judgment. They think that the people that do the jobs that pay minimum wage are worth less than they are. I mean, let's be super real. The reason why Republicans want other people to be paid less is because they want to feel like they're better than somebody. And because of that, they don't feel like going through all of the logical steps of how our economy works and realizing that maybe we need a higher minimum wage. They'd rather just feel superior to somebody, and so it's easier not to really think too much about your policies or ideas. Like, for example, Republicans very often will tout this idea that somehow if we decrease taxes on corporations, they'll magically pay more in taxes because economic growth is going to be that much more. But if you ask why the economic growth would be that much more, their entire logic starts falling apart. The reality is that companies end up spending more money on investment and employees when tax rates are high, because it turns out that investing in things like research and development and employee benefits not only increase the value of the company, but also give some pretty sweet tax breaks that companies like to take advantage of. So the higher the baseline tax rate is, the more an incentive these companies have to hire more people. That is what would stimulate economic growth. But Republicans have a fundamentally short-sighted view of the economy and can only see to this next quarter. And so they want the money now. They want these higher profits now. They don't want to think about long-term growth or economic stability. They just want it now.
The economy is very strong.
Powell doesn't look convinced of what he's saying.
And against the backdrop of an extremely tight labor market and high inflation, the committee anticipates that ongoing increases in the target range for the federal funds rate will be appropriate.
So the Federal Reserve has decided to raise interest rates between 1/4 percentage point and 1/2 percentage point. But after watching this press conference, I'm not convinced Jerome Powell believes this will be the solution to current inflation.
Do you think it's possible that the Fed's estimates of the lowest sustainable unemployment rate may have been too high?
Absolutely.
So what does raising interest rates have to do with inflation and the target unemployment rate? I would like to hear Jerome Powell's response to the same question, especially when it comes to current inflation, but usually it goes something like this. When we raise interest rates, it becomes more expensive to borrow money, less people will take out loans and invest in their businesses or start new ones. This means less growth in the economy and more people will become unemployed. Then we have many people competing for the same jobs, and this will drive wages down, meaning people have less money to spend on goods, which decreases demand. This also means that with less people working, less people will have money, also decreasing demand and driving prices back down.
Of course, the objective is to achieve price stability while also sustaining a strong labor market, and that is our overall objective, but we do feel the economy is very strong and well positioned to withstand tighter monetary policy.
The Federal Reserve has given itself two options for making monetary policy: raising interest rates and decreasing interest rates. It's extremely outdated to still be relying on the Phillips curve to describe the dynamics of inflation, making monetary policy with the assumption that there's an inverse relationship between unemployment and inflation. Economists within the United States and around the world have described the dynamics of inflation to be much more complex than this. And while Jerome Powell doesn't necessarily agree with them, he does say that the Fed often gets the target figure wrong.
So we overshot in what our long-run unemployment rate is.
I think we've learned, as you pointed out, that you can't identify, this is something you can't identify directly. I think we've learned that it's lower than we thought, substantially lower than we thought in the past.
And I've been seeing lately that economists are increasingly worried that the idea of a Phillips curve that links unemployment and inflation is no longer describing what is happening in today's economy. Have you been considering on that? What are your thoughts on that?
Yeah, very much so. We spend a great deal of time on that. The connection between slack in the economy, or the level of unemployment, and inflation was very strong if you go back 50 years, and it's gotten weaker and weaker and weaker to the point where it's a faint heartbeat.
There are concerns that having more people unemployed and driving wages further down could bring us into a recession. So unless we get the pandemic under control, resolve the supply chain issues, and Russia gets out of Ukraine, we likely won't see dramatic change in our current inflation. So maybe Jerome Powell looked the way he did in this press conference because he's just as worried about the limits to what the Federal Reserve can do to get current inflation under control.